And then the final message, I think, from 2025 is the AI story. Clearly, we're seeing a huge investment, potentially trillions of dollars being invested in AI story. And that's from the chip makers like NVIDIA, the foundries that make them like TSMC in Taiwan, the companies that make the machines that make the chips, ASML out of Holland, for example. We're also seeing massive investment in the data centers themselves, which is in part a real estate play. And that's why we're seeing Goodman Group, which makes up 40% of the Australian property index, powering ahead. They also use massive amounts of power. So we're seeing a fair bit of development in the electricity infrastructure, both from a generation side and from a distribution side. It's flowing on to the people who service those. So the electrical contractors, the suppliers of air conditioning, the people who provide the racks and security systems. The AI companies themselves are largely funding this from equity. So this is not a debt-fueled 1999, late 90s internet boom. These companies investing in these are extraordinarily cash positive. So the Googles and the Amazons, they're just money printing machines, and they're recycling that cash and these massive cash reserves they built up to fund this development. There's also a fair bit of cyclical stuff where the purchase of the chips is being provided by new equity raised by the customers. So in some ways, that's a bit like the telecom equipment manufacturers providing vendor finance to the rollout of the mobile networks in the late 90s. The bit that bothers me is that at the property side, much of that is being funded by private credit. Should we end up with a surplus of data center capacity, just like we ended up with massive surplus of fiber optic capacity in the late 90s, those property companies could very well struggle. And because they're being funded by private credit, anyone who's invested in private credit could be exposed. And because it's called private credit for a reason that you can't actually see where your exposures are, that's where I get very nervous. And that in part is why we invest in global real estate, which is much less development focused compared to Australian real estate. So the Vanguard Australian Property Fund, or VAP, has massively outperformed the global equivalent. And 40% of that is the Goodman Group. They're building data centers like there's no tomorrow and logistics facilities for the Amazons of the world. So I'm not suggesting that's a challenge today. And of course, we don't do forecasts here. But that's, I think, the bit that keeps me awake at night. To answer the question about whether this AI thing is a bubble or not, I think it's useful to go and have a look at what is a bubble, what makes a bubble. Robert Shiller, who wrote the book Irrational Exuberance, which was taken up by Bernanke in the 90s, identified a half a dozen key indicators of what a bubble might look like. Clearly, sharp increase in prices. Tech, yes, we've seen that. Overvaluation, prices far exceed the historical norms. And certainly we're seeing valuations looked at on a price to earnings ratio. That is, what multiple of last year's profits do you have to pay to buy a share in NVIDIA? Answer, massive. Is that just because forecasts haven't caught up? We don't know, but I'm not sure when you look at the levels of growth that are built into those assumptions that were anywhere close to material overvaluations yet. The third point, the narrative, the popular stories, the AI is coming for our jobs story. This is the story that was told about the personal computer in the early 80s. It's the story that was told about the internet in the 90s, neither of which led to any job losses. I'm not sure that AI is going to be materially different to that. I think we may very well be doing different jobs. We may very well be doing different things. Some jobs will become more and more important. Some will become harder to justify their premium. I'm not sure I'd want to be an IT developer. And we're certainly seeing layoffs in the tech space, despite this build out. I think the jury's still out on that one. Tales of significant earnings, get-rich schemes. There's a bit of that around. And certainly when you look at where we moved from the first $1 trillion company to the first $4 trillion company, that didn't take very long. And so that's an area of concern, I think. Envy and regret, fear of missing out. Huge deal in the 90s. Being in investment banking in the 90s, when all these IT bankers were talking about new ways of valuing businesses, that earnings and profits and revenue were no longer relevant. We looked at numbers of users. We looked at anything to justify the prices. We're not anywhere near that yet. Of course, the media frenzy. We're seeing a lot of media frenzy. So there's Shiller's 6 markers. The other thing that's necessary for a bubble to form, which is why we see them in real estate, but not all that commonly in the stock market, is you need to have divergent views and the inability to hedge the negative sense. So if you form the view that real estate's getting too expensive and you think it's overvalued, you can't actually trade that position because it's very hard to short property. Sure, you can sell what you got, but it's pretty hard to go short the property market, whereas there is still extensive short positions in many of these players. So I think we're a long way from a bubble. This is a bit of an obscure slide, but this is really saying that when you look at current PEs, that is price to earning ratios, the number of years profit you have to pay to buy a share, they are by historical standards high today. I don't think anyone would argue about that. But today's valuation is actually not a particularly strong indicator of next year's returns, which might sound a bit surprising. So if it did, there will be some structure to this diagram. So this diagram just posts, for every year, it looks at the current year price to earnings multiple average, and then plots that against the return you achieved in the year after that. On the S&P 500, just as an example, they would form a trend if there was a link. And this is a shotgun blast random. So there's nothing here that tells me that there is any particular forecasting power in today's price to earnings ratio. That's not to say we should ignore it, but I think that even though we have a share market that's heavily dominated by these players, if you're invested in the Vanguard Global Share Fund or any global equity index fund, you have 20 cents in the dollar invested in 10 of the big AI players: NVIDIA, Alphabet, Microsoft, Amazon, Broadcom, Meta, Taiwan Semiconductor, Oracle, ASML, and Palantir. That's a heavy concentration by any measure. It's about the same as the Australian share market concentration in financials, to put it in context. And it's less concentrated than the top 10 in the Australian share market. But nonetheless, many of those companies, NVIDIA at $4.3 trillion, that was one not that long ago. Alphabet at 3. So, it's not that long since we had our first $1 trillion company. And now we have 1, 2, 3, 4, 5, 6, 7 of them here in the top 10. And so, yes, it's concentrated, not as much as you might think by reading the paper, and possibly a good reason why you don't necessarily want to be allocating your capital in accordance with global equity indexes. So we've always split the US out from the rest of our global allocations. So we've been using IVV, that's the BlackRock S&P 500 fund, to deliver the US, and then we use an ex-US global equities to provide the rest of the world. And that allows us to tone down how much of that money goes into the US. So today the US is 70% of the global share market index, yet the US is 26% of global GDP. On a nominal basis, about 14% on a purchasing power parity. So we've under-allocated the US. So we're sitting at about 40% today. That's 40% of the global equity component, whereas the index is sitting closer to 70. And we think that's prudent. And then always good to put it in the context of history, and having lived through this and spent some time fixing up some of these assets that came off the wrong side of that 99 boom. So the reddish color here is 1997 to 2000. The blue line is 22 to 2025. So we have a long way to go, and there is a fair bit more substance to the businesses that we're seeing making up those multiples. There's not too many grocers.com or pets.com that we saw back then. So this is not 1999, to be very clear. If it keeps going for the next 2 or 3 years, well, maybe we could get there. But today, we're a long way from that. So that's really all I wanted to say about 2025. It's a great year, and it's great because the major indexes produced an average to slightly above average return. Gold and small caps delivered massively. Infrastructure's coming roaring back from its COVID downturn. And even we're starting to see some green shoots in the global real estate market, despite the fact that office property is not worth what it was while we still work at home. We're starting to see some physical transactions come through in the real estate market. So the Australian residential real estate market continues to grow at above average growth rates. Sydney's 40-year average is about 5.8% a year. I think we did about 6.5% last year. So whilst interest rates remain low, that's probably likely to continue. I mean, I started the year with a view that the risk on interest rates was on the upside rather than the downside. I think the RBA is starting to make those sort of noises. So I think the probability that the next change is up rather than down has definitely increased. 2 days ago, the RBA held rates, but they were very much hinting that the risks were on the upside, that inflation's remaining stubbornly resistant to the application of the interest rate lever. And so therefore, up is more likely than down.